Morning, Mark, and welcome back to Blue Notes. You've been in the chair since February now, running the institutional business, which incorporates a lot of the Asian focus of the bank as well. Conditions have been tough in institutional banking, and I know in previous trading updates and the other interim report, we were talking about that. How are you seeing conditions in that space at the moment?
Yeah, they probably haven't changed that much during the year. If anything, they haven't improved, but they haven't got significantly worse, I think, Andrew. I mean, interest rates have still continued to come down, as you know, and that hurts a business like ours. Secondly, you've seen, margins to customers and customer lending has still continued to come down, but not at the pace that we've seen. So if anything, that's moderating, which is good. Regulatory and capital costs are still there, and if anything, there's further focus on it. So they haven't. I don't think they've worsened significantly, but they haven't improved, and we're seeing a stabilisation is the way I'd look at it.
And on the credit quality front?
Well, the credit quality, it's interesting because we haven't seen any significant new big issues. It's more working through the ones that we currently have on the sheet. I think that's stabilising too. We've moved back towards the long-term norm in our business, and I'd expect that to continue maybe into next year, but I don't see it deteriorating much from where we are.
And in the half-year report, there was evidence of a simplification of the structure, which I know is one of the things that you're doing. You made good progress there in improving performance. Do you see that continuing at that pace through to the full year, for example?
Yeah, look, I think we've gone to a very simple organisational structure, 3 geographic heads and 3 product heads. That's working its way through the rest of our organisation. And we just announced our new 3-year strategy. So a lot of what we said we'd do with the org structure is in place, and if anything, it's just settling that down now, and that's what I'd look to do next year.
In talking about that simplification of the business, you do have a new strategy. What is that new strategy? We
took it to the board about 3 weeks ago now, Andrew, and I've been travelling around talking about it in town halls around the world, and it's very simple. Good strategy is simple, and there's 5 elements to what we're doing to get our business back to where we want it to be. The first thing is that we're really focusing on the industries that create value for us, where we're very good. Things like agri, natural resources, funds and banks, areas where we see some growth in health and in technology, for example. So we're focusing a lot of our resources going forward and sharpening our focus on key geographies. That's the first point. The second point is that we have around 6,000 core customers that create most of the value for us. So we want to sharpen our focus on them, and as we're doing with our risk-weighted asset reductions, move away from customers that don't want to pay for our services. And by doing that, we'll declutter our client base to a degree, and that means we can focus on the key ones, about those 6,000, and grow from there and get rid of the customers that really aren't paying for our services. And we're doing that through exiting some of the commercial customers that we have and other customers that might be single product, for example. So that's the second point. The third point is that we want to ensure that our geographies are clear in what role they play in our network development. So we've got five categories now of what we expect from our geographies, and each of them will have a really critical role in playing the development of the network, but it will be differentiated services in each of those geographies. So that's the third point. Fourth point is to just streamline what we're doing in our systems and also in our products, ensure that the products that we're managing are relevant to the sectors, the industries and the customers and the geographies that we're operating in, and that our systems are the same across each of those geographies. And then finally, just continuing what we've been doing with simplification and improving efficiencies, risk-weighted asset reductions, simplification of our org structure and our systems and processes right from end to end. So that's a very simple strategy, 5 key areas, and we think when we execute, which we will, we're very confident of the execution on this, we'll end up with our return on our business back well above our cost of capital, which has been our ultimate aim.
Shane Elliott made that point about the risk-weighted assets in the trading update, and the market seemed to respond quite well to that. But in terms of your customers on the ground, reducing that means some customers are leaving the bank, and for the businesses on the ground, how is it playing out there?
Look, it's been received relatively well. I mean, a number of customers that we've seen where we've been say underperforming and we wanted to get a change in risk-weighted assets, particularly out of the US, we've gone to see some really significant names. And when we explain our position around the need to get our risk weights down or get the mix of business changing so we get a better return, they've responded really well. And some really big multinationals have said they want to continue to deal with us because they like our network Australia, New Zealand, in particular Asia. And so customers are responding in different ways, but the big customers understand our position. The second point I'd make here is that we have about 6,000 core customers that make all of our value. A lot of the customers where we're running down risk-weighted assets are ones that we consider non-core, and so there's not been a real pushback from customers. If anything, they understand our position.
Indeed, you touched on the network in Asia being valued, and since Shane came to the wheel here, there has been talk about the Asian footprint, but that connectivity, the network effects that we have in Asia, that is valued by customers?
Look, absolutely, and we've said it a number of times that we're not exiting Asia. It's absolutely not the case. In institutional, we're reshaping what the geographies will do for us, the role that they'll play in that connectivity, and which really just gives us a sharper focus in each country. But the customers still value what we said 8 years ago, that the regional network would be of great value. If anything, the relevance to our customers is being enhanced with what's happening around the world. So that network is extremely valuable. The customers tell us it is, and more of them are still coming to us to get access to it. So it's as relevant today as it was 8 years ago.
And when you talk about the power of that connectivity in the network, what are you really talking about? Are you talking about people on the ground in different countries, or is it the product mix?
Yeah, it's all of that. It's the people. It's our capability to connect customers who want to do transaction banking or trade. They might want a little bit of lending in the country. It's a combination of all of those things. But what has to happen is that our systems and our processes need to be simplified and knitted together so that they get the same experience across those countries. And that's what we mean by our connectivity. We need to provide the right level of and same level of customer experience in each of these regions, so that the customer gets one response, if you like, from our bank. And that when you get that continuity, it's really valued by the customers, and that's what we heard from a number of these, for example, the US companies who've said that they want to continue doing business with us and have worked with us in changing the mix of business to get a better return.
I mean, it's a sort of long-held marketing position that banks have said we can give you the same experience across a network. How close are you to where you think it is a consistent experience?
We're still probably 12 to 18 months away. We've got, for example, 3 versions of our transaction banking system called Transactive that we have currently deployed. So if a customer accesses that in our regions at the moment, they might get 3 different sign-ons. Now, within the next 12 months, that'll be one, and we'll have one transaction banking system called Transactive Global, which they can use across all of our network with a single sign-on, and we think that's a better system than what Citibank has today, and who have always been renowned as the best in transactional banking, and I think this system will beat it. So 12 to 18 months on that. I think we're simplifying our product ranges. We're going to, from various versions in our trade system and in our market systems to one. As you start to get that, we've got one loan system that we deploy globally. We'll have series of global product lines and platforms, if you like, that'll for the first time in this bank, which will allow us to have one operating system, if you like, across those product areas. And it's going to be a new experience for our customers and our bankers.
Look, thanks very much, Mark, for talking again with Blue Notes.
Thank you. Thanks, Andrew.